The strategy most investors rely on was designed for economic conditions that no longer exist.
Americans are not feeling any better about the overall economy.
The U.S. economy is facing a make-or-break moment.
The U.S. economy lost 92,000 jobs last month.
Goldman Sachs putting the odds of a recession within the next year at 25%.
Your portfolio was probably engineered for a world where the Federal Reserve could step in, cut rates, and fix things. But we are headed into a scenario where that tool doesn't work, where the cure for inflation makes the economy worse, and the cure for a weak economy makes inflation worse. That scenario has a name: stagflation. Most portfolios today are built for one of two economic environments: growth, where stocks rise and the economy moves forward, and recession, where economic activity slows. The entire architecture of modern portfolio strategy, the 60-40 split between stocks and bonds, diversification models, and risk frameworks, was designed around those two scenarios. Stagflation breaks both systems simultaneously. Prices rise while economic growth slows. Stocks get hit because corporate earnings weaken. Bonds get hit because inflation destroys their fixed returns. The Federal Reserve, the institution most investors quietly count on to step in and fix things, is completely handcuffed. Raise interest rates to fight inflation, and you risk pushing an already weak economy deeper into a slowdown. Keep rates low to support growth, and inflation keeps rising. There is no clean answer. The policy trap is what made the 1970s such a brutal environment for investors, and why stagflation remains one of the few scenarios that most portfolios are simply not built to handle. So why are economists beginning to talk about stagflation again? Several major forces are starting to converge, and it's the combination that matters. The first is energy, and this one is no longer theoretical. The Strait of Hormuz is a narrow stretch of water between Iran and Oman that carries roughly 1/5 of the world's entire oil supply. On March 2nd, following the strikes on Iran, the Islamic Revolutionary Guard Corps officially declared the strait closed. Tanker traffic has dropped to near zero. Analysts are already calling this the biggest energy crisis since the 1970s oil embargo. Oil prices have surged, and the ripple effect is just starting to work its way through the global economy. We don't have to guess what comes next. We've lived it. In the 1970s, an energy shock pushed oil prices up roughly 300%, and what followed was a decade of stagflation that wiped out the purchasing power of millions of Americans. Rising prices, collapsing growth. The conditions that triggered that decade look a lot like the conditions we're watching unfold right now. The second force is debt. In a healthy, growing economy, that's manageable. But if growth slows while borrowing costs rise, servicing that debt becomes significantly harder. Historically, governments facing that kind of pressure often respond the same way, by expanding the money supply. In other words, printing money. And every new dollar created reduces the purchasing power of the dollars already in circulation. The third factor is institutional sentiment. Goldman Sachs has already downgraded the U.S. economic outlook. The Federal Reserve is navigating a leadership transition in a critical moment. When institutions with the world's deepest research capabilities start revising their outlooks downward, that data point belongs in the conversation. Now, here's where it gets interesting, because history gives us a clear picture of what happens to different assets in a stagflation environment. The picture involves hard assets, assets whose supply cannot be manipulated, printed, or artificially inflated by any government. Think silver, real estate, commodities, gold. Their value holds precisely because nobody can create more of them overnight. Any asset with a real finite supply tends to hold and often gain value in times like these. Across more than a century of geopolitical disruptions, one pattern appears repeatedly. When inflation rises and confidence in paper currency weakens, hard assets gain. The Vietnam War is one of the most striking examples. As inflation accelerated during that period, gold rose more than 400%. During the stagflation decade of the 1970s, gold moved from $35 an ounce to more than $800 an ounce. Hard assets perform best when real interest rates are negative. Real interest rates are calculated by subtracting inflation from the stated interest rate. If a savings account pays you 3% while inflation is running at 6%, your real return is negative 3%. Your balance goes up, but your purchasing power goes down. Stagflation almost perfectly engineers that environment. Inflation rises faster than interest rates can increase without harming the economy. So real returns on traditional assets collapse, and investors historically move toward assets that hold their value independent of monetary policy. Take gold, for example. Gold is priced in dollars. When the purchasing power of the dollar declines, which is exactly what persistent inflation produces, gold strengthens in response because your dollar buys less of a finite asset. It's a mechanical relationship. Most investors spend the majority of their time thinking about how to grow their wealth. Far fewer spend enough time thinking about how to protect it. And that difference in mindset is never more important than when the economic environment shifts in ways the conventional playbook didn't prepare for. Stagflation is one of those shifts. Now, you don't need to panic. You don't need to make dramatic changes overnight. But there are 3 questions worth asking about your portfolio right now. 1. If inflation remains elevated for the next 3 to 5 years, how does your portfolio perform? 2. If economic growth slows at the same time, what happens to your stock investments? And 3, do you own anything that isn't directly tied to either of those risks? The final question is often the most difficult to answer, and that gap between what your portfolio is built for and what the economy may actually deliver is exactly where purchasing power bleeds out. Now, the investors who navigated the 1970s most successfully weren't the ones who predicted stagflation. They were the ones who had asked hard questions about their portfolios and made adjustments while they still had time and options. That window is always open, until it isn't. Understanding how the system works is the first step. The second is making sure your portfolio reflects that understanding. If you're struggling to answer these questions for your own portfolio, reach out to the team at Noble Gold Investments. They've helped thousands of Americans ask the right questions, get real answers, and take action.